Meta announced earnings last night. Let's get into the details. First article here we have is from the Wall Street Journal. They report that the last report was a bit less impressive, with first quarter revenue of $36.46 billion, only narrowly beating Wall Street's forecast, and projected second quarter revenue falling short of analyst forecasts. That second quarter forecast, calling for revenue to grow 18% year over year at the midpoint, also represented a notable deceleration from the 27% growth seen in the just ended period. Meta share price tumbled more than 16% in Wednesday's after hour session. So they had record revenue, beat some forecasts, and the stock still goes down. Obviously, the stock market is very unpredictable, and there could be a million reasons why that might be. But let's talk about the details for Meta. So what are the factors that lead to that? We got a little bit more details here. Meta Platforms on Wednesday reported record first quarter revenue as the company's advertising business grew at a rapid clip, even as investors soured on forecasts of rising costs related to artificial intelligence. Shares slid more than 12% in heavy pre-market trading after Meta said it would increase its spending levels for the year up to $10 billion to support infrastructure investments to support its AI investments. The decline came despite an increase in sales to $36.5 billion, up more than 27% compared to a year prior, a record for the January to March period, exceeding analyst expectations. The revenue growth was up slightly compared with a quarter prior when Facebook parent Meta reported annual revenue growth of 25%. So here we have the first factor in the outlook for Meta, and that's their AI investments, how much they're going to cost, how are they going to monetize that. There's a lot of companies have put out models and they're making some money off of it, but these models are very expensive to create. So it's interesting to see how Meta plays in this arena. Let's continue. Those advancements in AI have helped Meta overcome challenges posed by privacy changes implemented by Apple that erased $10 billion of revenue for the social media company in 2022. So this is another factor weighing on their performance. You'll remember a couple of years ago, you'd start getting apps. If you were an iPhone user, you'd start installing apps. You'd start getting questions about whether you want to, quote, ask the app not to track, which is just another way of saying Apple turned off an API that would help companies like Meta track you across the app and the web. And Apple turned that off, part of their privacy push. And that cost, according to this article, Meta $10 billion in 2022. So another factor. So going back to AI, shareholders are enthusiastic about the potential of AI, but are also closely scrutinizing how much companies are spending to build out AI models and applications, as well as the strategy for making money on the new technology. So this is a typical Wall Street take, very skeptical, curious about how much these AI models cost to build, and also how are you going to make money on them. So obviously relevant questions for any business, but these AI investments are so widespread. So many companies are doing it, and it's so expensive. It's very unclear who the winners are going to be. So Wall Street taking a skeptical look. So continuing with the AI factor, tech giants such as Meta, Microsoft, Google, and Amazon are now pouring billions into generative AI. Let's talk about what those billions are going to. Most likely it's going to, some of it for employees. Probably the bulk of it is going to data centers, infrastructure, compute horsepower. These models are very compute intensive and require a lot to train them, less so to run them, but they're very expensive to train and build and create. And that's the stage we're in right now. All these companies are racing to build the best model. So it's very expensive. So if you're NVIDIA, a chip maker whose GPUs are used to make these models, or if you're a data center company, probably a good time to be in that business. I'll continue. With the revenue contribution either unclear or a long way off. So, it's like that old adage, if you were in the gold rush era, the best business wasn't to be mining gold. It was to be selling tools to the miners who were going for the gold. Don't take the risk. In this analogy, that would be NVIDIA, the chip makers, the data center companies. These investments are happening. And whether AI becomes huge, like a lot of people expect, or becomes kind of one of those passing fads in Silicon Valley, remains to be seen. So thought there on how to play this financially. Zuckerberg was at least candid on the last point, telling analysts on Wednesday's conference call, "I expect to see a multi-year investment cycle before we're fully scaled Meta AI, business AIs, and more into the profitable services I expect as well." CFO Susan Li added that CapEx is expected to be even higher next year as we invest aggressively to support our ambitious AI research and product development efforts. So count Meta in the race to build huge AI models. That's going to be very expensive. And I don't think all these companies are going to win. We've got Meta, Microsoft, Google, and Amazon. Probably not all of those are going to win. We usually see one or two win out. So it'll be interesting to see which business model wins here. And then just on a quick aside here about Google, I think it's been said, but I'll just reiterate, Google might have the most risk here. If AI becomes very good and improves from where it is now, their internet search business, which is their core business, a huge moneymaker for Google, might have the most risk in that it is replaced by these AI models. So I'll quote here the Wall Street Journal. But while Google has been a bit hamstrung by investors worried that Gen AI chatbots will displace its core business of internet search, the Facebook parent has the advantage of being able to integrate AI into its ad business without worries that the base of the nearly 3.2 billion people checking in daily will somehow disappear. The Meta moat is likely to continue growing with new Gen AI ad tools. Brent Thill of Jefferies wrote earlier this month. Interesting perspective there. Google might have the most risk. I've always thought Google had the lowest moat, if you will, and that changing a search engine is probably one of the easiest things to do in tech. Changing your phone, I mean, that's a multi-day process, pain in the neck if you're going from, one ecosystem to the other. So interesting take there. Couple other points I would like to make. They're going to spend $40 billion in AI. If Meta's going to spend, billions, tens of billions, they need some breakthrough capabilities. They need either new capabilities or drastically improve what AI is able to do today. I've seen that AI's accuracy or, correctness when asked a question is somewhere around 80%. For most business use cases, that's not good enough. It's good for an interesting toy, something to play with, something interesting, something to help brainstorm, something to provide another perspective to a conversation, but 80% is probably not good enough. So these companies that are investing in AI, they either need new capabilities and new things that AI can do, or they've got to really improve, I'll just say, the accuracy or the correctness of what these models provide. And also it's interesting to see how Meta is going to be able to compete with Google and Microsoft. Both of those firms have experience creating development tools, services. Meta has experience providing tools and services to advertisers. It has experience providing experience to end users, customer experience, but it's a different customer base, right? Their main current customer base is advertisers. If they're selling AI and it's not just another part of their core product feature set, it'll be interesting to see if they can compete with the Microsofts and the Googles and the Amazons who have extensive experience creating services that developers consume or, technical people integrate into other products. And then lastly, obviously, Zuckerberg has been, over the last several years, talking a lot about the metaverse and how that's the future. And they've spent billions and billions, probably tens of billions on that. Switching the company's focus from building the metaverse, which is a graphics intensive exercise, almost, a lot of skills you get from the video game industry, to AI is a big shift. There are some overlaps, use of GPU, how to make use of the hardware, that kind of thing, but it is different. So it'll be interesting to see how the tech talent moves between the firms and how this shift in investment affects Meta and how much longer are we going to hear about the metaverse? And how much stomach does Zuckerberg and his shareholders have for him to keep spending money on it? It's yet to really show traction. That is my take on Meta's earnings announcement. Be interesting seeing where the stock goes. Obviously, Wall Street's skeptical right now. It's a big price tag. It's a lot of money. So I get it. But hope you enjoyed the analysis. And if you have any comments, please drop them. And like and subscribe. Thanks for watching.